Today, under the theme 5 Factors and Solutions for the US Economic Downturn, I will provide an in-depth explanation based on the original content of each factor. Hello, this is ChoWorld. Please note that this is not a buy or sell recommendation, so exercise caution with your investments. The first factor is the liquidation of yen carry trades. In Japan, the yen had been continuously weak for the past 15 years. However, due to recent inflationary pressures in Japan, the Bank of Japan has been forced to raise interest rates. As a result, investors who were accustomed to a weak yen and held dollar assets may suddenly become concerned about a reversal to a stronger yen due to the abrupt interest rate hike. In other words, there may be a phenomenon where investors hurriedly sell their dollar assets and purchase yen in order to liquidate their yen carry positions. Such a situation poses the risk of triggering a liquidity crisis throughout the market and could lead to a sudden drop in asset prices. As a remedy, Japanese authorities are striving to curb long-term interest rate rises by simultaneously increasing short-term rates and expanding the purchase of 10-year government bonds. This policy aims to mitigate the appreciation of the yen and minimize the abrupt market shock caused by the liquidation of yen carry trades. The second factor is the concern over a slowdown in the US economy. The United States is facing difficulties due to a combination of factors such as the imposition of tariffs, high interest rates, and a strong dollar. Tariff impositions are not merely trade issues, they also lead to higher production costs and consumer price increases, which result in an overall contraction in consumption. In particular, as trade frictions with other countries intensify, the burden on US companies and consumers increases, directly contributing to the economic slowdown. Both the government and the Federal Reserve may consider cutting interest rates to stimulate the economy in such a situation, but they face a difficult choice due to the need to balance inflationary pressures. Moreover, the necessity for flexible tariff policies and trade negotiations is being emphasized to alleviate the burden caused by tariff issues. The third factor is the issue of the national debt and the debt ceiling in the United States. The US is facing rapidly increasing debt alongside continuous fiscal deficits. According to the original text, there is a high risk of reaching the debt ceiling between July and October this year, and if that limit is exceeded, the United States faces the risk of default, meaning a failure to meet its debt obligations. This situation could not only deliver a severe shock to global financial markets, but also lead to adverse effects such as a decline in the US credit rating and rising government bond yields. As a remedy, raising the debt ceiling and expanding government bond issuance are being considered. However, these measures may lead to an explosion in the supply of bonds and an increased interest burden, necessitating careful management. The fourth factor is the issue of mutual tariffs. The United States is actively imposing both general tariffs and industry-specific tariffs. As a result, other countries are increasingly likely to impose reciprocal tariffs as a form of retaliation, which poses a risk of disrupting the international trade order. For example, tariff adjustments aimed at enhancing export competitiveness through exchange rate manipulation or the weakening of the national currency could be aggressively implemented against major trading partners such as the Dirty 15. As a solution, the government is required to adopt a flexible tariff policy that allows for leeway and to make efforts to mitigate reciprocal tariff conflicts through strategic negotiations. This approach does not merely stop at adjusting tariff rates, but aims to restore trust and strengthen cooperation throughout trade relations. The fifth factor is the instability of emerging markets. The environment of high interest rates and a strong dollar in the United States exerts severe capital outflow pressure on emerging markets. Emerging countries, due to their small economies and vulnerable financial market structures, are inevitably sensitive to changes in US policy. As a result, there is a risk that the value of emerging market currencies will decline and financial market instability will increase, potentially leading to an economic crisis in the worst case. As a solution, it is emphasized that emerging countries should improve their own financial market structures, bolster their foreign exchange reserves, and prepare for external shocks through international cooperation. In addition, mitigating emerging market instability through close coordination among global policy authorities is also proposed as an important solution. Now I will explain the policy response signals corresponding to each factor. In times of crisis, the government and central bank are sending signals such as Trump push, Ueda push, and Powell push. These terms indicate the willingness of the government and the Federal Reserve to supply liquidity to the financial market through lowering Treasury yields, easing quantitative tightening, and expanding Treasury purchases in times of crisis. Such policy signals provide short-term relief to investors and prompt a rapid shift to buying during market downturns. However, at the same time, it is important to be wary that excessive reliance on government intervention could lead to long-term structural issues. To further explain market investor sentiment, investors often perceive a market decline of about 5% as an opportunity for bottom buying. While this sentiment, combined with expectations of artificial government intervention, leads to rapid asset purchases in the short term, there is a risk of a sharp shift to selling if actual support is lacking. Therefore, investors should always keep in mind not only short-term sentiment, but also the importance of long-term risk management and investment diversification. The importance of international cooperation and policy coordination cannot be overlooked either. Major countries, such as the United States and Japan, are coordinating their interest rate and monetary policies according to their respective economic situations. For example, Japan is making efforts to curb long-term interest rate increases and a sharp appreciation of the yen by simultaneously raising short-term interest rates and expanding 10-year Treasury purchases. Similarly, the United States is attempting to manage debt issues and upward pressure on interest rates through measures such as adjusting Treasury supply and easing quantitative tightening. Such international policy coordination plays a crucial role in stabilizing the global financial market and establishing a foundation for long-term growth. However, while these various solutions may help mitigate short-term crises, it is also important to consider that they inherently carry long-term issues, such as an expansion in debt issuance and reliance on government intervention. Ultimately, the 5 major factors of the U.S. economic downturn and their corresponding solutions interact in a complex manner, and a thorough analysis of these interactions provides important implications for future policy decisions and investment strategy formulation.